Hey, good morning, everyone. Marty Mazzora here. It's the 2nd of December, 2025, with a market update for you. Going to keep this one very brief. Right now, we are spending a lot of time, I am in particular, on updating our overall strategy as we enter 2026. Looking at the strategic reallocations, rebalancing, things like that, heading into a year that we believe is going to be characterized by a number of themes or potential themes. On balance, next year may be less geopolitically volatile as this past year has been. We expect that the overall tariff regime will not get worse. In fact, the market's response to tariffs and increased tariffs and the response from policymakers to the market's response suggests that there's plenty of incentive to soften at least the rhetoric around using tariffs going forward. There's also the pending Supreme Court decision around tariffs, which would have very interesting implications if indeed they were deemed unconstitutional, and if indeed the importers, the U.S. importers, were to get refunds of the billions of dollars that they've paid into the Treasury via that tax, that tariff. The jury, so to speak, is very much out on that. Mixed feelings about whether or not that will come to pass. I think the administration has a plan B to keep the tariffs on, or the majority of them on, that they think they can implement successfully if indeed the Supreme Court rules against them. But I honestly think that any reason to lessen the blow would be very welcomed by markets by and large. Now, the reason I add that by and large is because there should be a caveat that anything that would be deemed stimulus, like hundreds of billions of dollars refunded to U.S. importers, again, I think the markets would welcome that. Initially, we do have interest rates, we do have inflation in the current environment to be concerned about as well. And it gets exacerbated by the government's need to issue Treasury debt to fund the very large budget deficit that we're currently running, even with the tariff revenue having been received. So that's going to be very interesting. Also, the One Big Beautiful Bill Act really pumps some serious fiscal juice into the economy next year and the year after. And so we've been studying where that juice, so to speak, is going to be applied within the economy, and will rotate within our portfolio to reflect the potential for those places to do very well. So the portfolio going forward is going to have more of a tilt toward U.S. infrastructure, U.S. energy infrastructure, and again, quite a bit of spending going in those directions. There's certain ways to express that using ETFs and perhaps a few individual positions as well, which we are now researching with all this AI infrastructure spending and what it means potentially for utility stocks on an ongoing basis. And I'm just kind of giving you hints as to where we think perhaps some notable opportunities lie next year. At the same time, we've got these macro considerations. On one end, the labor market appears to be softening. And on the other end, we are going to be pumping a lot of fiscal stimulus into the economy. It could be, if I wanted to be very optimistic, kind of a Goldilocks scenario where the generally weakening in the economy, perhaps the strain of the tariffs, if they're allowed to continue and so on, will somewhat offset the potential inflationary impact of a whole bunch of new spending. Now, that's counterintuitive to a lot of people because a lot of people believe that tariffs are inflationary. And I've pushed back a bit against that here in the past by telling you that they are a tax. And taxes actually are disinflationary or deflationary. You get a one-time pop to the extent that the importer can pass that on to customers in an attempt to not squeeze their margins too much. But then it doesn't keep going up. Inflation would be the ongoing rise in prices. And of course, to the extent that someone has to pay a higher price for one item, that's less money that they have to spend on other items, i.e. less potential demand, and therefore the cost of those other items should contract to compensate for the reduced demand. So that's where you would come to the conclusion that on balance, tariffs are actually disinflationary. So we've got these various forces, these various narratives pushing against one another. And these are things that we're having to think long and hard about, try to quantify what they ultimately mean, while taking into account valuation extremes in the U.S. tech space, particularly in a few very popular stocks, and the continued mismatch that I charted for you a lot at the beginning of 2025, the mismatch between valuations among U.S. and many other foreign jurisdictions or foreign markets, from just about every conceivable angle. And despite the fact that we've done notably better in our non-U.S. exposure than U.S. exposure in 2025, that mismatch, that relative value still exists outside the U.S., particularly in certain sectors and in certain pockets. So that is something we need to continue to exploit, which has been a very good thing for us this year. We've had a very good year, exceptional year relative to the broad, U.S. equity average that a lot of people benchmark to. But I always need to take every opportunity to remind you clients that yours is not a stock market portfolio by definition, meaning while equities are a very important part of it, and they will be going forward, so are other exposures, other asset classes, commodities, gold, silver, platinum, natural gas expressions that we have in the portfolio as well that have done very, very well for us this year. And then, of course, the global exposure. And all that really explains more than anything else why we've had I would say, an unusually good year relative to the overall risk we're taking, the diversification, the hedging, and so on. But to illustrate how different your portfolio is in an all stock market portfolio, today, for example, the core allocation is down 0.19%, while the S&P 500 is up 0.13%. So it's not huge. The Dow is actually up more. The Dow's up just 90 points, so up 19 basis points. The S&P equal weight index, which would more reflect a diversified portfolio of stocks, is down 0.21%. Again, our core is down. Right now, actually, it is down 0.21%. But gold is down over 1%. And that's a big position for us that is up over 60% this year, by the way. U.S. material stocks are down over 1%. Energy is down 1.5%. Consumer staples, which is close to our biggest U.S. sector weighting, is down 1.2% today. On the upside, though, uranium miners are up over 2%. Vietnamese stocks are up 1.5%. Tech is up almost 1%. Individual biotech position is up 0.2%. Applied materials is up 3%. These are smaller positions, but when you add them all together, Europe is up 0.5%, which is important for us, and several others are nicely in the green. So actually probably a little more than half of our portfolio is actually in the green today. However, with those positions like gold being not small, when you weigh it all together, we're down now 21 basis points, 0.21%. Speaking of that, let's just look at breadth. I did dial up here. Here is the year-to-date. The white line is the S&P 500, up 15.9%. The S&P 500, all the same stocks, equal weight, up just 8.3%. So the market broadly equally weighted is up 8% this year. When you concentrate it like the S&P cap weighted is, then you get double that. I read here this week where two stocks, and I believe it was Google and Nvidia, make up 30% of the gain in the S&P 500 this year. That's the kind of concentration, folks, that doesn't make you feel real good about the sustainability of this level or these gains going forward. Doesn't mean they can't be, but boy, I think there'd have to be a big broadening out of the space. Another way to look at it is the IMAP, Bloomberg's screen here. You can see the S&P up 0.2%. 64% of the stocks in the index are down, even though it's up slightly. Tech is up, industrials are up, Boeing's up a lot today. About half of the industrial stocks are up. Communication services is up, but only 60% of those stocks are up. Financials is, call it flat, with half of those up. So most of the sectors, again, energy down 1.4%, materials down 1.2%, commodities in general are taking a pretty good hit today, which would usually mean the dollar is higher, and it is just a smidgen actually right here. Actually, it had a nice pop and then rolled over off of its 200-day moving average, as you can see right here. So the dollar's still up a little bit on the day. Yields are definitely higher, but off of their highs as well. So they were up. The dollar was probably up with yields. I would say the dollar's chasing yields. And you can see as yields have come off the boil a little bit here, so has the dollar. Just kind of jumping around now. Gold, as I mentioned, is taking a pretty good hit today. That's that blue candle. You can see it's trying to fight its way back up to all-time highs. We are hedging our position about 10% out of the money. Gold can take a massive, more than the 11% hit that it has here when it's as overbought on the long-term charts as it is. In fact, it's rare that that's all we get. So we need to be hedged against something, 20 or 30% down in gold, which wouldn't surprise me. Oh, I also had volume loaded up here today. As you can see, this is the S&P 500. Relative to the 20-day average volume is down considerably, 13.4% below. So not a lot of conviction in today's move one way or the other. And the move was noticeably higher, and you can see it's come off the boil. But when you don't have much volume, that means you don't have much conviction. As for the one-year daily chart, you can see that, we had a nice pop earlier. It's coming down off of that, still up on the day. I've got just a real short-term trend line right here that's offering some support. Right about 67.70 or so, those two lines converge. So I would expect, we'll see if the market wants to come down and maybe challenge the 50-day moving average, which it continues to challenge, and then recover. We shall see. Long gap between there and the all-important 200-day moving average. So, yes, potential downside in this market is not small, as I continue to reiterate. But as I keep reminding you, it's very good seasonality here, and wouldn't surprise me to see that play out this year, barring some bad news, either data that would have the Fed potentially bring in the potential for no rate cut in December. In fact, let's go ahead and look at this while we're at it. So right now, we're still pricing in, my goodness, a 98% chance now of a Fed rate cut in December. That's something that the market should love. And no doubt that, as I said earlier, explains this move right here. Remember, we were 27% chance of a Fed rate cut, and then Fed speakers began talking the market back up. This tells me that they are committed to, at least right now, cutting a quarter point in December. They would not go against a 98% probability, I assure you. The QQQ, the NASDAQ 100 ETF, you can see it's regained its 20-day moving average, which is an important short-term support and resistance level. The fact that it broke it and is now recapturing it is somewhat bullish short term. Longer term, we still have these divergences that are going to have to be burned off for us to feel real confident about the next few months. So folks, I think I'll just kind of stop right there and come back at the end of the week with more. Hope you have a great rest of your day. Thank you as always for watching and listening. Talk to you later. Bye.